Should we invest in real estate or should we invest in stocks? This is an age-old question that a lot of people have tried to answer. In today's video, I'll be talking about that in context of new immigrants. I'll also be talking about who is real estate for and where stocks still make sense. And we'll be doing actual numbers, and I've prepared a very comprehensive presentation that would not only give you an indication of what's best for you, but also tell you what I do and why I do it. So let's get started. Alright, so let's go to the presentation where we talk about whether to invest in real estate or whether to invest in stocks. Now, the biggest difference, and that is really massive, the biggest difference why a lot of people invest in real estate over stocks. A lot of people have generated a ton of wealth by creating real estate portfolios is because of something called as leverage. Let's understand what the leverage is and what is this equation that arises from leverage. So for example, if you have $100,000 and if you invest those $100,000 in stocks, what happens is if these stocks grow by 10%, which is a very healthy growth, you get $110,000 of that same stock. So if you invested in Apple stock in $100,000 in that, and if that grows by 10% in 1 year, 6 months, whatever, whenever that grows, you get $110,000 of Apple stock. And that is a $10,000 profit and a 10% return. Simple equation. And let's talk about real estate now and how that works and why people actually double down on real estate so much. So talking about real estate, if you invest $100,000 in real estate and assuming that's 20% down on a $500,000 house. Now the difference is if the house value increases by 10%, your house becomes $550,000. That's a $50,000 profit, and that $50,000 profit has happened on your $100,000 investment, and that's where you get a 50% return. Now the difference here is that I'm not talking about your primary house. Your primary house is, even though it's an asset, it's not a liability, but it's taking money away from you because you're paying the mortgage. I'm talking about an investment property here. This difference, this particular comparison is for an investment property that you build for cash flow where tenants live and you are not living in it. So just remember, all these calculations and everything that we discuss in this video is for an investment property. And if you have $100,000 to invest in stocks versus real estate, you need to look at it like that. Now let's look at this difference in leverage, the 50% return that we are getting, and let's break it down into what's the return in 1 year, 5 years, 10 years, and let's compare stocks versus real estate so that it makes it very clear on why we make more money on real estate than stocks. So let's talk about if you invest the $100,000 in the stock market, the money is invested at a rate of return of 10%. Now guys, 10% is a really good return, and I'm just taking that to prove that even if we get a 10% return in stock market, how real estate can actually beat that. Now let's talk about year one. So for 1 year, if you invest $100,000 and if you get $10,000, which is 10%, you make $110,000. So that's the money that you realize. That's how the $100,000 grows to $110,000, and the profit is $10,000 on that, which is $110,000 minus $100,000. For 5 years, if you keep that money invested, you do not put a dime in, you do not take anything out, the money grows to $161,000, and now the profit is $61,000. If you keep that money invested for 10 years, it grows to $259,000, and now the money is actually compounding itself, and we talked about that in our last video, and the profit is a whopping $150,000, and for 20 years, it's $672,000, the profit is over $500,000, and in 30 years, which is usually the length of the mortgage, and it's also usually if you are in your mid 30s or early 30s is when you retire and stop working, you would have a profit of $1.6 million, and if you add the initial investment of $100,000, you would have $1.7 million, and that in itself is amazing. However, let's talk about what happens if you invest the same money into real estate. Now, if you're buying a house of $500,000 today and you're buying it for cash flow, you're buying where the tenants are living. To buy this house, you do a 20% down because for every investment property, you have to do 20% down. So that's $100,000, and you also have closing costs of $10,000, which is 2%. And then your overall cost to buy this property becomes $110,000, and you take the other loan of $400,000. That's what you are leveraging. That's the thing that you are taking from the bank. And then we talk about our expenses for that house. The expenses for the house obviously include the mortgage payment. Now this is at a 4.5% interest rate for 30 years. So the mortgage payment will be $2,000, property tax will be another $300, insurance is $125, then you have vacancy. Vacancy basically means that your house will not be rented out for the entire 12 months. So usually the vacancy is taken at about 5%. I have taken it 5%. So it's $150. Property management is about 10%. So let's assume it's $300. You have repairs, and it's very important to take repairs because, for instance, for us, when we rented out the condo that we have, there was a repair of $550, which was for the dishwasher, and I had to do that in my second month. So there are always repairs that happen, and you should account for that. So the total cost of owning that, or all the expenses taken together, is about $3,000. And let's just assume that you are getting a rent for $3,000. Now guys, these are our real numbers for our Calgary house. So it's not hypothetical. This can actually be achieved, and we are hoping that we will be at least break even on that house, if not make a little bit of profit. Now let's try and understand how we make money. The same calculations we did for 1 year, 5 years, 10 years, 20 years, 30 years for the stock market, we'll do it for real estate. But in real estate, it gets even more complicated, and I'll try to break it down as simply as possible. Now we have taken a loan of $400,000. Our cost to own this loan, or which is the down payment and the closing cost, is about $110,000. Let's take a rate of return of 6%. What this means is that the property value, and this is a real number, in the last 40 to 45 years, property value has grown 6% year on year. That's a very nominal growth that I'm taking. In the last 5 years, it's grown a lot more. I'm not talking about anomalies. When I talk about real estate, I talk about long-term investing, and we'll talk about that in the next slide. But let's assume that the rate of return is 6% vis-a-vis the 10% that we were getting in the stock market. And the mortgage balance. So what this means is that because you are paying a mortgage, and in fact you are not paying it, the tenant is paying the mortgage, your mortgage balance is reduced from $400,000 where it started from to $392,000. So you paid $8,000 worth of, you paid it down to $8,000 by $8,000. The value of the house right now is $530,000, and the reason why it's $530 is because it has appreciated by 6% in 1 year. 6% appreciation over 500 is 530. Now if you sell the house after 1 year, your cost to sell the house will be about 5%. That again is something that people do not account for. You have to pay the realtor, you have to pay the legal fees. So let's assume that the cost to sell is 5%. So your bank would have $111,500 after all the costs. So this has actually been achieved. If you subtract $392,000, that's the loan that's outstanding, from the 530 that we have, that's the value that you sold the house for, and you deduct your selling costs, you get $111,500. You invested $110,000, and that basically means that you made a profit of only $1,500. So you actually do not make any money on this house if you sell the house in 1 year. Now things get very interesting when we talk about 5, 10, 20 and 30 years. That's why I like to invest in real estate for long term. I'm not gonna sell the houses for at least 10 years, and I'll tell you why. In year 5, you actually pay down $37,000. So your outstanding balance is now $363. Again, you have not paid it. The tenant has actually paid down the mortgage. Your value has now increased. Even if we assume 6% every year, it has increased now to $669. Your selling cost again becomes 5% if you sell the house. And after all these costs, and assuming that your house sells for about $670, you bank $272,000, and that's a profit of $162,000. So in only 5 years, you actually almost doubled your money. And in 10 years, it'll be even more, and in 20 years it'll compound to even more, and by the end of 30 years, assuming a 6% growth in real estate for the house that you're buying every single year for 30 years, your mortgage obviously will be zero, and you didn't pay it, the tenant paid it, and everything inclusive, you will have $2.6 million. The reason why real estate actually trumps stock market is because of leverage, and real estate actually helps you grow and make money in 3 different ways. The number 1 way is you make money on cash flow. So in this particular example, we have taken $3,000 of rent, and our total expenses is $3,000, but over time the rent actually increases and you keep building cash flow. So you actually make some money every single month. The second way that you actually make money on real estate is equity pay down. And again, if you do the numbers right, the tenant actually pays for that equity. So this pay down that happened for $8,000 in 1 year, That's money that you made because someone else paid down that equity. And the third way to make the money is, of course, appreciation. And that's because the property value has appreciated by about 6%. That's the money that goes into your pocket. And those are the three reasons why real estate would always trump stock market, even if we assume a 10% growth in stock market versus a 6% or a 5% growth in real estate. So if you put this side by side, so this was the slide that I had for stock market, and that was at 10%, of course. If we put this side by side with real estate growth of 6%, we'll see that we do not make enough money to cover for what we made in the stock market in year one. And that's because, your cost of owning that house is way too much. And if you sell the house, you actually have fees and everything. But over the next 5 years, you'll actually make $100,000 more. Over the next 10 years, you'll actually make almost $250,000 more, and so on and so forth. And by the end of 30 years, you will have a fully paid down asset of $2.6 million that's paying you rent, which is much more than $3,000 that you started with. And that's the reason why a lot of wealthy people made their money through real estate. Now, there's one more reason why people like investing in real estate, and that is that you can actually make material change in that mortgage to improve the value by more than 6%. What I mean by that is you can renovate the house. And that's very much underrated. If you're investing in stocks, for instance, if you invest in Apple stock, you are a passive investor. You can't make decisions for Apple. Apple will make decisions for themselves. And if they make a profit, if they make the right decision, their revenue grows and you get a dividend and you get a growth and you get an appreciation. But in a house, if you are willing to put an active work into that, you can actually make material changes to the house. You can renovate the house. You can add additional units to it. You can make a basement. You can do so much. And therefore, you can actually increase the value of that particular real estate by more than 6%, and that's in your hands. And therefore, a lot of people actually like real estate over stocks because you can have a bigger impact personally on the value of your property. But you know what? All this is just too good to be true, because it is. Because there are some pitfalls and some mistakes that a lot of people make. I have also made those mistakes. So we have just been in Canada for about 2.5 years, and the reason why I feel that we have not made a lot of those mistakes is because I learned from people who have done it in the past. And that's where mentorship comes, that's where having a good team comes. But there are some pitfalls, and I want to talk about that. Number one is poor choice of location. We bought our condo in downtown Kitchener. The reason why we bought in downtown Kitchener is because it's just outside of Google office. It's just besides Manulife office. There's a Deloitte office, there's a KPMG office. It's just center of everything. There's a public transport there. So location is really important when you are investing in a property. And if you have a poor choice of location, you could actually go wrong in your purchase. The second one is not knowing your numbers. So I always talk about, if you're buying for yourself, you need to do a rule of 35. So that basically means that your overall expenses for the house should not be more than 35% of your net income, not your gross income, but your net income after taxes. But if you are buying an investment property, you need to talk to someone who actually knows the numbers, who actually can guide you through the numbers. When I talk to my clients, I actually do something called as a rental analyzer. I use that to calculate cap rates. I use that to calculate what's our walkaway point. We actually have to take out the emotion out of the purchase and work with only numbers, and only if they make sense, you need to buy the property. So it's very important that you talk to a mortgage agent, you talk to me, book a call from the description below, and we'll talk numbers. The third value killer in real estate is not having the right team. And that comprises of a realtor, a mortgage agent, and a lawyer. And if you're buying to flip a property, if you're buying to turn renovations, you also need a team with good renovation skills. And that's where a good mortgage agent and a realtor will be able to help you. So always make sure that you have a perfect team together so that you are able to make a really good long-term decision on the property that you're buying. The fourth value killer is thinking that it's passive income. Real estate is not passive income. If you're looking for passive income, you should keep investing in stocks and get dividends. The reason why I say that is that sometimes what happens, and from my personal experience of just recently, tenanting out my condo, I told you, right, my dishwasher broke. And I had to go all the way to Mississauga to get that part that broke because the tenant cannot work without a dishwasher, right? So I had to drive all the way to Mississauga to get that part because it was not available anywhere else, and that was active work. If you are buying a house that's run down, if you are buying a house that needs renovation, there's again active work required. So do not for once think that real estate is passive work. Yes, it can be. If you have held the property, if you have good tenants, if you are well settled in that house, and the tenants are well settled in that house, it can be a passive purchase, and that way you can make passive income. But you can't go in with that assumption, and that's the number 4 point that people go wrong on. The number 5th point, and that's very, very important, is that there is no exit strategy. That's the biggest mistake. I see a lot of people buying real estate, buying investment properties, reaching out to me, reaching out to realtors without having an exit strategy, without knowing where the money will come from. If you're buying an investment property, you need 20% down. Where would you get that 20% down? A lot of people actually have HELOCs on their primary home, and they think that they can just use the HELOC, but they don't have an exit strategy on the HELOC. HELOC basically is home equity line of credit. It's on your primary house that you own, but it's still debt. So you can't keep going into debt without making enough income and without having a plan of how you will get out of that debt. Plus, I see a lot of people, the other day I was talking to someone who was buying a $1 million house with a $3,500 of rent. Those numbers, when we did on our rental analyzer, actually was minus $1,500 cash flow on the entire purchase. That is not a good investment. So always talk to your mortgage agent on what your exit strategy is, and go into a purchase only after you know this and only after you're confident about your numbers. Now, number 6 point, that is the biggest value killer, is that you're trying to make a quick buck. And by that, I mean that you're trying to flip a property. Now, you cannot be a professional flipper. Now, if you are a professional flipper, you need to make sure that you're buying really low. You cannot just go into the market and think that, okay, let me just buy this property. I'll buy it on a private loan. I'll buy, by taking more debt, and then I'll do some renovations, and I'll just, flip it. That actually worked when the market was good. It doesn't work in every kind of market. It certainly doesn't work in today's market, where you don't even know whether you'll be able to flip the house for a higher value just because the market is actually going down, that the economy is struggling. So it's very, very important that you buy real estate for long term, especially if you are new. And if you are in the market to flip the property, you need to make sure that you're working with an amazing team that can get you a house that's way below market price. Then you have amazing renovators who can renovate the house and then give you the value that you are looking for. So it's very important for new investors, especially, to just go into the market and invest for long term till the time they are able to build a team like that. Now, that was all the points for real estate, and I personally love real estate a lot. I'm still learning, and that's why this channel name is called Grow with Nav and not Grow from Nav, because I'm still growing, and I want to pass on all the knowledge that I'm gaining via this channel. Now, there are a few reasons why people should still love stocks, and I still love stocks, and there are 4 reasons why I still will continue to invest in stocks while I'm building my real estate portfolio. And the number 1 reason is that I can start with $1. I do not need a big down payment to buy a house. I can actually start, if I have $10,000, I can put that in the Apple stock, or I'm just saying Apple stock for the heck of it, it can be anything, right? I usually invest in ETFs and dividend stocks, but you can do it your own research and invest into something. But the point here is that you can actually invest with very little money. Then there's no active work involved. Yes, there is some research involved in the kind of companies that you want to invest in, but still there's no active physical work involved. There's just desk research. And then once you have identified the companies that you want to invest in, you just do it over and over again. The third thing is that the money is actually liquid. If you buy real estate and if you want to sell real estate, it could take months to sell it. But for stocks, if you need the money, you can just sell it. Even if you sell it for a loss, you incur capital gains, whatever that happens, but still the money is pretty liquid and you can actually take it out in a couple of days. Then you have the 4th reason, and that's probably the biggest reason why I still love stocks, and that is because I can buy slowly and dollar cost average. Now, what I mean by dollar cost average is I usually invest $500 every single week into ETFs and stocks. And the reason why I do that is because I want to make sure that while the market is going down, I'm able to dollar cost average. So if the stock market is up, I buy less shares. If the stock market is down, I buy more shares. And that way, over the next 30 years, I'm able to get an average return of 8 to 10%. But I can't do that with real estate, because if I invest $100,000 and if that's all the money that I had, it will be very difficult to buy another house in another month just because the market has gone down. So I can't buy real estate slowly. And there's actually one more reason why I love, and that's not a big reason, but I like to diversify. I don't want to put all my eggs in one basket. I don't just want to do real estate. Yes, my business is real estate. Yes, I do invest in investment properties. I do continuously look for them, but I also want to have some liquid cash sitting around which can be used in case of emergencies, in case there's a need, or in case I just want to diversify my portfolio and have a different stream of income. I think I'll just feel safer if I diversify my entire portfolio into stocks and real estate and other things as well that we'll more and more talk about on this channel as well. That's all I have for today. I hope you liked this video. I hope you got some insight into why some very wealthy people invest in real estate and why it's not for everyone and why there's a place for stocks as well. If you like this video, please do subscribe to the channel. I see that there are about 60% people who watch the video but do not subscribe to the channel. It will really help me motivate and keep making these videos. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।